Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's February 24th, 2013. Stocks were mixed again last week, as the S&P 500's turned to be down slightly, bringing its 7-week winning streak to an end, although the Dow Jones managed to be up a small amount thanks to Hewlett-Packard. The Russell Small Cap Index, which has been beating them both, had a bit of a reality check when it fell 3% between Tuesday's close and Thursday afternoon. All of the indices fell on Wednesday, when the minutes from the last meeting of the Federal Reserve's Monetary Policy Committee were released. It seems that some members are worried about the amount of money the Fed is pumping into the financial system, currently $85 billion a month, or a little bit more than $1 trillion a year, as well as the difficulties of figuring out when to shut down the pump and how. What a scandal. And so 2% of losses later, the Fed sent in the cavalry. St. Louis Governor James Bullard, known as a hawk, went on CNBC television before the open on Friday to reassure us that Fed policy is going to stay very easy for a long time. Other prominent members weighed in as well, defending the need for aggressive monetary policy. And so markets rebounded 1%. The fact that markets fell so much in 2 days in the wake of a suggestion that the Fed might slow or stop the program one day, then rebounded by half when it said it still can't see that day, is it a good indication of how much stock market gains in the last year or two have depended on central bank action. The Fed wants to push people into stocks with its zero interest rate policy that make other assets less attractive. More importantly, from the trader's point of view, it will ride to the rescue of every market downturn, or so the theory goes. When markets went on a tear last month, the press kept talking about the improving U.S. economy and, I quote from a major market weekly, that Europe is hitting on all cylinders. Really? In the week just past, Caterpillar Tractor had its turn in the spotlight with its latest 3-month sales tally. Global sales down 4%. North American sales down 11%. Some of the problem came from dealers carrying too much inventory. But doesn't that say a little something about demand? Caterpillar is what we call a cyclical company, and they tend to turn before the rest of the economy. As for Europe, the latest GDP data came out, and it was a disappointment across the board. And so were the purchasing manager surveys that came out right afterwards. Germany was the only country not in negative territory, and as a result, the European Commission cut its outlook for 2013 from a little bit of growth to a little bit of recession. But European markets were largely unchanged, with the London FTSE up on the week. Although Friday afternoon, after the close, the UK's credit rating was downgraded. Will the real economy matter at some point? Yes, but it takes longer than you think. Right now, the market is shrugging off the bad signs, just as it did in 2007. The bull market was about 4 years old back then, too. Remember the sequester? Well, the markets don't, not yet, even though it's coming this Friday. And many think that a larger correction will come in March as weakness in the global economy becomes more evident, and they may be right. But there are also 2 central bank meetings in March, and the European one was dropping hints of an interest rate cut last week. At this time of year, markets don't like to go down. Traders want those all-time highs, and the Dow is barely 1% away. They might get them. But if you're not a day trader, it's a dangerous time to be trying to squeeze out that last 2 or 3%, because I don't think it will stay there for long. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.